Well, the cost of carrying some loans is rising again. That's after the Bank of Canada decided to hike its benchmark rate by 25 basis points. So it's now 1.5%. Jeannie Lee is here with more on that. So, of course, Jeannie, anyone who's borrowing money, whether you're a consumer or business, it's going to be more expensive now.
Well, we're waiting for the prime rate to go up at the big banks because the big banks tend to follow the Bank of Canada in raising their benchmark rates. And once that happens, yes, it's true that some forms of loans and some forms of borrowing will rise in tandem. And so lines of credit, some types of personal loans, and certainly those variable rate mortgages will cost more. And we'll just show you how much today's hike will mean for a mortgage of $100,000. For every $100,000, the monthly payment will go up by about $13. But this is not just today. This is the fourth rate hike in a year. So cumulatively, we're looking at somebody with a variable rate mortgage who is going to be paying $260, $300 more a month. It's now in the hundreds, so it's starting to hurt much more. So the bank, it had been hesitant to raise rates too quickly, too much, because people do have so much debt in Canada. But the other thing is, there's been a lot of uncertainty over what NAFTA will look like once the negotiators are done with it, and also this now burgeoning tariff dispute between the U.S. and Canada. Don't know what impact that's going to have on the economy. So the bank had to tread lightly, but at the same time, it had to watch inflation. So here's what the bank had to say about the effect of trade disputes on the economy and why it has to stay cautious. This effect of uncertainty is now judged to be larger given mounting trade tensions. Although there will be difficult adjustments for some industries and their workers, the effect of these measures on Canadian growth and inflation is expected to be modest. Now, that's all in the present tense. The bank went on to say that it will be watching all of this and will continue to adjust accordingly, interest rates accordingly, depending on the data, depending on what happens with the economy. That's also a hint, though, Diane, that it could adjust rates lower if it finds that this trade dispute actually hurts the Canadian economy much more than anticipated.
Right. That's not a trend we're necessarily expecting, but it could happen.
It could happen, and it certainly made it that clear in the last line of its statement today.
Right. Okay. Thank you so much, Jeannie.
You're welcome.
And now we are heading to Ottawa to take a look at Governor Stephen Poloz about to speak and talk about that interest rate decision. Let's listen in live.
30 to 40 minutes. To my left is the Senior Deputy Governor of the Bank of Canada, Carolyn Wilkins, and to my far left, of course, the Governor, Stephen Poloz. Governor Poloz will start with some opening remarks, and then we'll be happy to go straight to your questions. Libre à vous de poser vos questions dans la langue officielle de votre choix, and we'll do one at a follow-up, so please just indicate to me if you'd like to ask a question. I'll take down a list. With that, I'll hand it over to Governor Poloz for his opening remarks.
Okay, thanks, Jeremy. Good morning, everybody. Senior Deputy Governor Wilkins and I are pleased to be here to answer your questions about today's interest rate announcement and our monetary policy report. Before taking your questions, I want to give you some insight into Governing Council's deliberations. Our discussion began with the big picture. Inflation is on target. The economy is operating close to capacity. Our outlook published today is that this situation will continue. Governing Council believes that higher interest rates will be needed to keep inflation on target, and that's consistent with our actions today. Évidemment, la politique monétaire dépend toujours des nouvelles données, surtout quand celles-ci ne cadrent pas avec les projections de la banque. Ces dernières semaines, certaines données ne semblaient pas encore avec ces projections. Mais quand on considère l'ensemble des données, l'économie semble en bonne voie. Given the various uncertainties that we face, the bank is particularly data dependent at this time. However, that doesn't mean that monetary policy will react to every data fluctuation. A better way to think of this is that it takes hundreds of data points to make a complete picture, and each new one helps the picture come into sharper focus. So when a data point comes in differently than what the bank or other forecasters expect, it matters to the big picture, but it's almost never decisive on its own. Now, as we've previously discussed, an important issue we face is to understand how the economy reacts to higher interest rates, given the high debt loads being carried by Canadian households. We're monitoring this situation very closely. We've seen a moderation in credit growth, and the debt-to-income ratio has begun to edge lower. At the same time, the housing market is also dealing with the revised B20 lending guideline, and the data don't yet permit a sharp distinction between the impact of the guideline and the effects of higher interest rates. Governing Council did take some comfort from an analysis of the renewal process for 5-year mortgages taken out in 2014 and 2015, which are up for renewal in 2019 and 2020. Now, this analysis shows a very modest increase in debt service ratios compared with the date of origination. N'oublions pas que beaucoup de ménages ont vu leurs revenus augmenter ces 5 dernières années, et ils ont pu s'habituer à des revenus plus élevés. Ils pourraient devoir s'ajuster quand le ratio du service de la dette va remonter. Cela aurait un effet sur les dépenses de consommation. Of course, this issue is most important for highly indebted households. We also know that the jump in payments will be greatest for those who took out mortgages when interest rates were at their lowest levels. That's in 2015 and 2016. So the mortgage renewal process is likely to weigh on the economy more in 2020 and 2021. All that said, Governing Council concluded that the economy should be resilient to higher interest rates, provided that labor income continues to grow. In our discussions, the biggest issue on the table was trade tensions. Comme nous l'avons déjà indiqué, l'incertitude entourant l'avenir de l'alignat a amené certaines entreprises à retarder leurs dépenses d'investissement ou à déplacer leurs investissements vers les États-Unis. Nous avions entrevu cette possibilité et nous l'avions intégrée à notre projection il y a un certain temps. The recent imposition by the U.S. government of actual tariffs on Canadian exports has made the situation more concrete. In the projections we're presenting today, we've added more negative judgment to our business investment forecast in recognition of this. We've also incorporated the effects of the U.S. tariffs on steel and aluminum and the various countermeasures implemented around the world. Box 2 in the NPR gives a flavor of the complex effects such actions will have. So let me summarize briefly. A U.S. company importing Canadian steel must now pay a 25% tariff. They may instead buy steel made in the U.S. or in some other country. Or, if no obvious substitutes are available, they may just pay the higher price. Or, the Canadian company may offer to reduce its price in order to absorb some of the tariff's impact. Or it may look to other markets to sell its products. La réaction des entreprises va dépendre de la période durant laquelle elles pensent que les droits de douane vont rester en place. Par exemple, il semble que si on réussit à renégocier l'alignat, ces droits de douane vont disparaître. Ce qu'il faut retenir, c'est que le résultat dépend des réactions de chacun, et ces réactions dépendent des circonstances. And then there are the countermeasures. Canada has imposed a 25% tariff on steel imported from the U.S. Now, this would seem to level the playing field, but many of the same complexities enter the analysis. All things considered, our analysis suggests that Canadian exports would fall, as would Canadian imports. Prices would rise at a time when the economy is already operating at capacity. So inflation would rise at least temporarily, but the effect could persist. Consumers would have less purchasing power, so demand would slow. Meanwhile, the potential of the economy would be eroded as companies invest less and become less competitive. So the economy would see shocks to both demand and to supply, resulting in two-sided risks to the future of inflation. Furthermore, the net effect on the economy might be buffered by any fiscal actions that governments might take. Now, as we said in the NPR, these various effects are likely to be small for the measures that have already been taken. In contrast, a large tariff on Canadian-made automobiles and parts would have a much greater effect on trade and the economy through these same channels. People are understandably concerned about this sort of escalation and want to know how monetary policy might react to it. Indeed, there was speculation that the bank wouldn't move interest rates today because of the possibility of further trade measures. But the bank cannot make policy on the basis of hypothetical scenarios. We felt it appropriate to set aside this risk and make policy on the basis of what has been announced. Given the multiple channels through which protectionist measures affect economies, it should be clear that monetary policy is ill-suited to counteract all of their effects. It may, of course, play a supporting role in conjunction with other policies. But to put it bluntly, the economy would slow, inflation would rise, and the exchange rate would depreciate, adding further to near-term price pressures in the Canadian economy. Therefore, the implications for interest rates of an escalation in trade actions would depend on the circumstances. Je tiens à le souligner. À elle seule, la politique monétaire ne pourrait pas réparer les dommages à long terme qu'une montée du protectionnisme pourrait causer à l'emploi et aux revenus. Cela dit, il ne faut pas oublier que notre économie est en bonne santé. Elle tourne presque à plein régime. Les entreprises investissent, même si certaines hésitent. Le marché du travail est vigoureux. Et surtout, l'inflation est accessible. It's important to remember that our economy is in a good place. We're operating near capacity. Companies are investing, even if some are hesitating. The labor market has been strong, and most importantly, inflation is on target. In this context, higher interest rates will be warranted to keep inflation near target. Governing Council will continue to take a gradual approach to adjusting rates guided by incoming data.
Jeannie Lee was listening into all of that as we were listening to the governor speak. And he did mention a lot of different considerations in terms of making this decision.
Well, it's like juggling a whole bunch of balls in the air and weighing each one to see exactly, what to do when it comes to rates. And he mentioned, Diane, that, given people's high debt loads, this is always going to be something that the bank has to consider, given how a lot of people really have massive mortgages and record levels of household debt. He did note that there's been some cooling in the addition to debt, so people aren't piling on debt like they had been for a while there. And also the housing market is starting to cool a little bit. But at the same time, job wages are going up. We see that in the employment report every month or so. And this means that maybe people are more resilient to higher rates. And that's why he figured, okay, well, maybe they can handle it. And so that would be a check mark in the column of yes to raise rates. But in the no to raising rates would be all of this uncertainty over trade. The NAFTA negotiations, don't know what that's going to look like at the end of all of the negotiations. And of course, now this tariff dispute between the U.S. and Canada. And so given that and everything else, the fact that inflation is starting to heat up a bit, especially with that wage inflation, he felt that rates were warranted in terms of an increase at this point.
Right. I mean, we know rates have been historically low for so long, in part because of concerns about the economy. So I guess he's saying, well, okay, now we know wages are pretty good, the economy's doing all right, we can start getting into a normal range, but that's still going to create pain for people who do have a lot of debt.
It sure will, because rates actually did not move. They were at rock bottom for 7 years until last year. In fact, it's going to be a year to the day tomorrow when rates started to go up 4 times now, including today. And all those people who borrowed heavily at that rock bottom level, in fact, Stephen Poloz mentioned that people who took out mortgages in this rock bottom era will really start to feel the pain in a few years when they renew their fixed rate mortgages. So he thinks that in the years 2020 and 2021, that's when the reality will hit for these people when they renew. So he did make a special mention of that.
Right. Okay. Thank you so much, Jeannie.
You're welcome.